When it comes to investing, for most people, retirement and children's education are two high priority goals. But because these are many years away, many of us postpone starting to invest for them to a later day. In fact, our 2020 survey by PGIM India Mutual Fund found that 51% of the respondents didn't have a financial plan for retirement. But investing for these goals should ideally be on top of your list because of the amount you will need for them. After all, the amount needed for both of these things are huge, and delaying means you will have to save quite aggressively. Now, mutual fund companies in India have specific mutual funds that are pitched as solutions for retirement and children's education goals. Together, these are called as solution-oriented funds. But should you be investing in these funds for these very important goals, or you should go for alternatives available in the market? In this video, we'll try to answer that question. We will start with retirement funds, look at their performance and how they have done compared to other alternatives, and we will then move on to children's fund and their performance. But first, don't forget to subscribe to our channel and press the bell icon so you never miss an insightful video from us. Retirement funds have been positioned by AMCs as a retirement solution. These funds have a lock-in period of at least 5 years or until retirement, whichever is earlier. Now, as of March 2023, about 18,000 crore is invested in them. These funds can be managed as equity, debt or hybrid funds. So the funds in this category often have multiple plans. For example, take a look at Aditya Birla Sun Life Retirement Fund. It has 4 plans. As you can see, the 30s plan is the most aggressive with about 80 to 100% allocation to equity, and the 50s plus plan is the most defensive with the entire allocation to debt. That's only obvious as when you are in your 30s, you are in the accumulation phase and hence you need more equity component in your portfolio. And as you near your retirement, you need more safety. So the 50s plus plan is all debt. Well, that's how Aditya Birla has configured its retirement fund. Other AMCs can have varying allocation towards equity and debt within their retirement funds. Overall, as of March 2023, there are 10 retirement funds available with 26 plans catering to various age groups and risk appetites. Some of them also offer automatic switching based on the change in your age group. For instance, Aditya Birla Sun Life Retirement Fund comes with a trigger facility. So if you have invested in the 30s plan and you turn 40, it shifts your money from the 30s plan to the 40s plan and so on. Some of these funds also allow you to save up to 1.5 lakh in taxes under Section 80C. For instance, all the plans of HDFC Retirement Savings Fund come with this benefit. Given the varied asset allocations of retirement funds, comparing their performance was quite tricky. So here is what we did. We grouped the funds based on how they were managing their assets into 3 buckets: flexi-cap, aggressive hybrid and conservative hybrid. By doing this, we could compare their performance with the flexi-cap, aggressive hybrid and conservative hybrid fund categories. One caveat before we go into details: retirement funds don't have a lot of history. Of the 10 available funds, as many as 5 came into being in or after 2019. Now, let's look at their performance. First, let's see how retirement funds managed in the flexi-cap style compared with the flexi-cap fund category. If you look at the 1-year returns, retirement funds have done better. However, they underperformed slightly when it came to 3-year returns. Now, let's move to retirement funds managed in the aggressive hybrid style. Here, retirement funds have underperformed the category average of aggressive hybrid funds in all investment horizons. And finally, coming to the retirement funds managed in the conservative hybrid style. Here again, retirement funds underperformed the conservative hybrid fund category in 1 and 3-year periods, and the margin is quite wide with difference of nearly 22% in 3-year performance. So as a category, retirement funds don't seem to be a better option compared to most popular fund categories as they have lagged behind. Still, it may be too early to comment decisively on their performance given the limited track record and data. However, if you look at the individual schemes of this segment, there are few old funds. Let's look at the performance of those schemes and see if anything changes. For these funds, we looked at their 5-year returns over any period from March 2016 to March 2023. That is the last 7 years. As you may know, such returns are called rolling returns. Now let's start with HDFC Retirement Saving Fund and its 3 plans: equity, hybrid equity, and hybrid debt. This fund was launched in February 2016 and has seen markets in all their shades. The first plan of this fund is the equity plan, which is comparable to the flexi-cap category. As you can see, across any 5-year period since March 2016, this plan has done better than the flexi-cap category. This is shown by the fund line in the chart, which is always above the flexi-cap category line. Let's look at the data in a different way. Let's see what have been the minimum, maximum and average returns of the fund in this period and that of flexi-cap category. The fund has beaten the flexi-cap category across all the 3 parameters. Now let's move on to the next plan of this fund, which is hybrid equity. This plan is comparable to the aggressive hybrid category. In this plan too, the fund has done better than the aggressive hybrid category in any 5-year period since March 2016. And that's why you see the fund line is always above the aggressive hybrid category line. The summary of the rolling return tells the same story with the minimum, maximum and even average returns more than the aggressive hybrid fund category. But what about the third plan of this fund, that is the hybrid debt plan? This plan is comparable to conservative hybrid funds. So let's look at the performance. Even this plan has done better than the conservative hybrid category. There has been no 5-year period since March 2016 when this fund delivered less than the conservative hybrid category. However, the degree of outperformance has reduced as seen in the narrowing gap between the 2 lines. This has resulted in not much of difference in the minimum or even average return between the 2. So all these variants have beaten their corresponding categories in terms of 5-year rolling return since March 2016. Let's look at another old-timer, TATA Retirement Savings Fund. The fund was launched in November 2011 and has 3 variants. Let's begin with its progressive plan that is comparable to the flexi-cap category. Now, as you can see in the chart, this fund did better than the flexi-cap category until around January 2022, after which it started to underperform. You can see in the chart how the return line of this fund has been below flexi-cap category post January 2022. But despite a period of beating flexi-cap category, its average returns are lower, but it does better when it comes to maximum and minimum returns. Okay, so what's the story with the fund's moderate plan? The fund started to underperform around February-March 2022. Before that, it had been doing fairly well. A quick look at the rolling return summary will help us understand the returns even better. The fund's minimum returns have been less than the aggressive hybrid fund category, while average return are almost similar. Let's finally see the fund's conservative plan. As you can see in the chart, the fund outperformed the conservative hybrid category until around August-September 2022, after which it started to have almost the same performance as conservative hybrid category. Let's see its rolling return summary. Thanks to its outperformance until August-September 2022, in terms of 5-year rolling returns, the fund does better than the conservative hybrid category across all metrics: minimum, maximum and average rolling returns. Finally, let's see the rolling returns of Nippon India Retirement Fund. This fund was launched in February 2015 and has 2 variants, Wealth Generation and Income Generation Plan. Let's begin with the Flexible Generation Plan, which invests like flexi-cap funds. From the chart, you can clearly see this fund has trailed the flexi-cap category by a wide margin. In fact, in none of the 5-year periods has this fund done better than the flexi-cap category. The rolling return summary also paints a similar picture. Okay, what about the Income Generation Plan? The fund's performance is quite mixed. Till July-August 2021, it did better than the conservative hybrid category average, went down till November-December 2022, and since then it has recovered and is performing almost at the same level as the conservative hybrid category. Here is the rolling return summary for your ready reference. So this fund too has been struggling to outpace conservative hybrid category. So what is the takeaway? There is no clear answer because at category level, retirement-oriented solution funds haven't outperformed the more popular categories. But there are exceptions like HDFC Retirement Fund. As their name suggests, children's funds are positioned as solution for children-related goals. Children funds have a lock-in period of 5 years or the child attains the age of maturity, that is 18 years, whichever is earlier. As of March 2023, over 14,300 crores are invested in these funds. There are 10 funds in all. Like retirement funds, children funds are also managed in varied style, with different combinations of equity and debt. Here is a list of available children funds along with their equity debt split as of March 2023. Now that you have understood children funds, let's see how they have performed historically. We have followed the same approach that we did in retirement funds and compared this fund with categories they closely resemble. Here is how children funds managed in flexi-cap style have done. As you can see in this chart, these funds have underperformed both across 1 and 3-year investment horizon. The downside protection provided doesn't seem to be too great either by these funds. Now, let's look at funds in this category that are managed in the aggressive hybrid style and see their performance. In this category, since we have funds with relatively longer history, the comparison is a bit more conclusive and insightful. As you can see, these funds haven't been able to beat aggressive hybrid category. Overall, based on the available history, children funds as a category have failed to deliver so far. Now, as we did with retirement funds, let's look at the performance of some very old time funds in this segment. HDFC Children's Gift Fund and UTI Children's Career Fund. HDFC Children's Gift Fund was launched in March 2001, so it's a very old fund. However, its direct plan came into being only in January 2013. Let's look at the rolling returns of these funds like we did for retirement funds. The investing style of HDFC Children's Fund is like aggressive hybrid fund. So we will compare its 5-year rolling performance with the 5-year rolling performance of the aggressive hybrid category average. In this chart, the fund line always remains above the line of aggressive hybrid category. What it means is that this fund has always beaten the aggressive hybrid category in any 5-year period since March 2016. Let's see the summary of rolling returns as well. And no surprises here, as you can see the returns of this fund are quite ahead in all the 3 parameters. Now let's look at UTI Children's Career Fund. This fund invests like FlexiCap, so let's compare the performance with the FlexiCap category. So as you can see, the fund started to underperform the category around April 2022. This margin of underperformance has become wider as seen through the gap between the fund and FlexiCap category lines in the chart. What could be the return summary like? See this on your screen. The fund hasn't been a consistent performer with the average and minimum both not beating the FlexiCap category average. So among the old timers in children's fund, only fund offered by HDFC Mutual Fund seems to be working. This can be sent for the entire category. Given this performance of retirement and children's funds, the million-dollar question is, should you go for them? Retirement and children's related goals have a high emotional value and at the same time look quite difficult to achieve. So it's only natural to go for solutions that solve the problem easily. However, as a category, these funds have yet to prove their mettle, plus they have limited track record. And there are plenty of well-established categories and funds with proven track record, and one can earmark specific funds for specific goals. On the positive side, the inherent asset allocation and rebalancing in these funds could be useful for investors. Their mandatory lock-in period can also prevent panic selling, thus increasing the holding period and ultimately improving the return experience. Last but not the least, the very names of this fund can be a psychological motivation for some investors. With this, we have come to the end of this video. If you liked the video, don't forget to like and share, and don't forget to subscribe to our channel.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.